So is this case closed?
Yeah, absolutely not. No, so we still have option three, and one of the ideas, right, of this podcast and what we do for a living, right, is being innovative, thinking outside the box, not being average. So what if we did both, right? We put money into this policy, we put $36,000 into this policy, and then we borrow against the policy, which is a huge part of bank on yourself, is banking on yourself, borrowing against the policy. And you could do whatever you want with this money. You don't have to take the loan out and invest it in the stock market. It doesn't have to be business related or investment related. You could do whatever you want with this money. But let's just say we did invest this money, and let's just say we invested it in the same place we invested in option one. Same types of financial assets, same investment advisor, same 8% projection minus the 1% investment advisory fee. What would happen then?
Mm,
So if we did it that way, we put $36,000 in, and then we waited until year two to take out a loan. So years two all the way down to year 29, we took out loans every single year of $25,000. We put into the stock market. What would happen? So at the end of year 30, net of taxes and fees, we'll have $1.9 million in the brokerage account. We'll have an outstanding life insurance policy loan of 1.759 million. That's every year we're taking out $25,000. We're not paying back one penny back to the insurance company. We're just taking out loans.
hmm,
And then we're assuming a 6.2% interest rate on this policy. And then assuming it stays the same for the next 30 years, we'd have $1.759 million as an outstanding loan that we owe the insurance company against the policy. So the idea here is, what if at the end of year 30, we took from the brokerage account, we took the 1.9 million, we pay off the policy loan, we'd be left with $144,000 in the brokerage account. We'll have $1.9 million in life insurance policy paid up.
mm.
There's no completely liquid, and we'll have $3 million in life insurance.
Wow.
And remember, in all three scenarios, option one, option two, and option three, the client is putting $36,000 a year somewhere. So $36,000 is leaving the client's pocket every year in all of option one, two, and three. So it's not like option three, he has to pay more money. It's the same $36,000 a year.
Perfect. So what I heard you say is start your whole life policy and find smart investments to make over the course of
Yep.
30 years. And that actually beats purely investing in the market, all other things equal. So, if I heard you correctly, at the end of all this, essentially we would go through, a regular repeating process where we put money into the policy via premium, borrow out 25 grand a year for the next
Mhm.
30 years or whatever. And at the end, we've got a big, hairy loan against our policy, but then we can pay
Yep.
that loan off with the proceeds of the brokerage account. I'd say, there's a lot of ways you can optimize this, but we're just showing the brute force scenario
Yes.
first. Right? So we'll talk about ways to optimize this to even get better results. But you're saying we'd have to we'd have to pull from that brokerage account. But even after we pulled from the brokerage account to pay off the policy loan of 1.7 million, we still got 144,000 extra dollars after taxes and fees and everything
Yep.
add to the cash value that, remember, why does this matter? Bank on yourself designed policy loans do not affect the growth of the policy. This is so important. If you're working with an insurance agent that is not bank on yourself trained and they've put you into an insurance company that offers, unfortunately, direct recognition policy loans, you cannot do this because direct recognition loans eviscerates or breaks the compound growth of the policy. But Sarah, you just showed us where we can access the money in the policy, go invest in things that you control and understand and feel good about. And then if all of the things equal with in terms of the investment return, pay off the policy loan in say year 30, and you get an extra $144,000 in your brokerage account. You still have the underlying compounding growth of the policy. You've you've earned 1.9 million in cash value, 144,000 in the brokerage account. My calculator says that's 2.1 million bucks. And you mentioned it too, the term insurance scenario 1, they lost all their life insurance.
Exactly.
But you just said that the death benefit on this whole life policy was, a little over just under $3 million. It looks like income tax free. So, what's the conclusion you came to as you did this math? What should we do?
Yeah, and we can even keep going. So I stopped illustrating here after year 30. So it's zero now. So it's $36,000 a year for 30 years and then zero for years 31 and up.
Mm,
But what if we kept adding in more money there in year 31 and up? Look what happens in year 30. We added in $36,000 right in year 30. How much of
yeah.
the policy increased by just in that year alone?
Wow. Okay, I'm looking at the spreadsheet here, and in the last year I funded my whole life policy. In the 30th year, I put in 36 grand, but the increase of my cash value was 111,000 bucks. Wow, that's like three and a half times my annual contribution.
Just in one year. So what if we kept going? What if we took the 144,000 from the brokerage account and then we kept putting in
Oh yeah.
more in the policy?
Mm,
We'd have significant growth. If you look at it here in year 31, you're not putting in any more money, but the policy grows by $80,000 with
by itself.
$0.
Wow.
So what would happen if you added in just five or $10,000 into the policy here? You'd have
Yeah.
significant growth, right? So that's kind of the idea. That's one of the things we could do. And again, there's more we can optimize. Like for
Yeah.
example, the 25,000 instead of all of the 25,000 going into the stock market. What if some of that went into a Roth IRA? What if the client
Mhm.
qualifies for a Roth IRA? Then we'd have
Mhm.
much less taxes in the future. We'd
Much
have no
less
taxes in the
taxes.
future.
Mhm.
We have,
Or tell
we
you
have,
what about this, Sari? What do you think of this? Most people, they like to buy and hold, but maybe
we
not
have
for 30 years. What if you could make a couple of smart moves throughout your lifetime and you pay off your loan on your life insurance every 5 to 10 years, let's say, rather than waiting 30 years to pay off that loan? What effect would that have on the loan interest and the cost of borrowing from this policy?
Yeah, absolutely. So the loan balance here that I have projected here at year 30, 1.759 million, it'd be much less, right? If we were paying off the
Mhm.
loans, less accruing interest on that amount, and definitely more money that we could either add back to the policy to buy up more life insurance, or we can invest back in the stock market if we really wanted to do that. We'd have that option. But yeah,
Mm.
definitely. And then from a financial planning standpoint, if a client told me that they're going to save $36,000 a year for 30 years, I would find it hard to believe that that's all they'll be able to save for the next 30 years. In other words, they're not going to make the
Yeah.
same exact amount of money for the next 30 years. No
Mhm.
pay increases, no bonuses,
Yeah.
no inflation, no like
Yeah, good
they're
point.
for sure probably going to be able to save more money in the future. So the additional savings can go to loan repayments, which can go
Yeah.
to more investments in the future.
Why would we see no, I think I see where you're going with this, Sari, but help our listeners understand your mindset. Why would savings be why would we correctly see loan repayments as a form of saving?
Yeah, definitely. It's going to translate. It results in more growth. So if this number is lower right here, if the year 30 the loan balance is lower,
Mhm.
then that means that the brokerage account amount would be higher, or the cash surrender value would be higher because we'd be allocating more back towards the policy. If there's room to add in towards the paid up additions rider and the life insurance policy, the loan, the whatever we could save can get reinvested back into the policy because this number would be lower right here,
Got it.
the
Yeah.
loan balance. So that would translate into almost like a form of saving or investing loan repayments.
Mhm. Yeah, that's a good way to put it. So, like, most people hear the word loan repayments and they don't think
Yes.
savings. That's not a form of Mark, I got a car payment. I repay my loan. That's not a form of saving. Well, no, this is whole life policy loans are different. When you have a loan repayment to your policy that you own and control, repaying the loan unlocks the dollars to spend again in the future. And so you're right, repaying a loan and I love the way you thought about this, Sari. I love the way your mind thinks in general. And this spreadsheet is a great example of that. But what you've got here is somebody who has gone 30 years. They're very likely going to have some pay raises. They're very likely going to have a couple of promotions or bonuses. Those extra dollars could go to pay down policy loans, so you don't have to spend so much of your brokerage account in retirement time when it's time to pay off this policy loan. That's only going to it's going to lower the cost of borrowing in the life insurance, since these loans on life insurance policies are usually simple interest all year long. That has the net effect of lowering your APR when you pay down loans over a reasonable period of time. This spreadsheet is awesome, but I say it breaks one of the 8 rules of Bank on Yourself, which is to pay off the loan over a reasonable period of time.
Yes, definitely.
One of our best, I guess, a Bank on Yourself professionals. His name is Jim Conrad. He has 8 rules, and I'll find his episode here for everybody. But One of the rules is pay off loans over a reasonable period of time, and that has the net effect of lowering the cost of borrowing. And I like your idea of let's find other means to pay off the loan so you can keep your investments growing and compounding in your brokerage account or whatever. And I like your idea too about the Roth IRA.
Mhm.
That we can spread around where these investment dollars go. So, um, I thought too, like as the investments come in and you earn some more, return on let's say your stocks or your real estate, you could add more from the profits of those investments into the policy as paid up additions, which only accelerates how fast this thing can grow, the policy itself. So basically, what I'm hearing you say is it's not either or. It's not
Right.
either invest in the market or get a whole life policy. It sounds like the best option is both and. Am I hearing that right?
Absolutely, yeah, definitely. It's not either or. We don't have to choose between the stock market or bank on yourself. We could do both, right? We could
Hmm.
do both, and we could even optimize it. Let's just say you wanted to stop putting in money into the market. You could do so. You could pay back loans sooner. You don't have to wait until you're 30. So there's a lot more control over this than I would say than just putting $36,000 away into the stock market alone. And again, this is we're giving the benefit of the doubt to the advisors. We're saying that you're going to get 7% every year, 8% minus 1% return. Again, what if there's another 2008 that happens? This policy itself is not going to be connected or correlated
Yeah.
with the market. It's not going to go down when the stock market goes down. So it gives you a little bit more kind of insurance for I wouldn't necessarily call it insurance for your investments, but I would look at it from that standpoint of this doesn't go down when other investments go down.
Sari, do you see this as a sort of stop loss in terms of what someone might lose? If you've lost everything, let's say your Bitcoin goes to zero, your
Yeah.
policy is still compounding, and it sucks because you're going to have to pay off that policy loan with something other than the investment returns. But let's say that you chose a meme stock that went to zero. Whoops.
Yeah.
But you borrowed from your policy. At least your policy is still earning interest and dividends and compounding as if you never took the loan to
Yeah.
invest. So at least we have that to sort of as act as a form of a stop loss. Do I understand that right?
Yeah, absolutely. Yeah, because once you pay off that loan, you're now more than where you started, right?
Right.
Because the train kept moving, right? The compounding never stopped. So when you pay back that loan, you're better than when you started with the policy. You're at a higher amount than when you started. So I would look at it from that standpoint as like a stop loss because the growth wasn't interrupted. You didn't lose just because the Bitcoin or the meme stock or whatever you invested in went to zero doesn't mean this policy goes to zero. So I like that idea, that analogy.
And so this doesn't have to just be stocks that we're investing in. It could be real estate, alternative investments, any income producing asset. If this was a income producing rental property, then that's even more, right? Because it's producing cash flow that you're not even showing on this spreadsheet, or dividend paying stocks, or the sky's the limit, right? There's no prohibited transaction on how you can use your cash value, right?
Exactly. Yeah, you could. I think it would even work better if you invested somewhere that generated income, so that way you could use the income to repay the loan faster, which means less interest to the insurance company that you're paying,
Yeah.
and more growth. So yeah, this is kind of like from an investment standpoint, I would say the lesser ideal way or less optimal way, meaning there's better ways to do this, and the better way would be to use the investment income or dividends to pay off the loan for more growth.
Is there anything we're missing or any consideration here that we need to make sure folks know about? Obviously, we can't give investment advice over a podcast. We don't know what stocks each person listening to this should
Yeah.
go buy. But in terms of like things to consider or ponder further, what do you recommend folks do a little more digging on?
Yeah, absolutely. I mean, when I first started this, right, I talked about we did $36,000 in the whole life policy for 600,000, or $1,600 a year for $600,000 in term policy. My question to you is, Mark, what if it was just a death benefit example? What if it was just a death benefit intent?
Hmm.
When are you most likely going to need life insurance? At the age of 40 or the age of 70?
Right.
Which one's more
Yeah.
likely to need
Like
life
older
insurance?
ages. Yeah. 70 or beyond.
Yeah, exactly. So one of the things that a lot of financial advisors would do is say, invest the difference. $600,000 in term is going to be way cheaper, but that's not really the likely thing. I mean, it's good, right? We're less likely to pass away when we're younger, which is a good thing. But the consideration for, even if this was a death benefit play, even if this was a death benefit intention for death benefit, whole life would still be a better fit than term, because we'd have all these years right here later
Yeah.
on. Let's say we pass away at the age of 100,
Mhm.
then we'd have, in this case, almost $6 million in life
Wow.
insurance. Yeah, exactly. Which is term. Term wouldn't be able to do that.
Well, term wouldn't even exist at that point for 99% of folks, so you're right. Let's